Have you ever scrolled through social media and seen people talking about buying the dip or investing in Tesla? Have you ever wondered what exactly they are buying? Today, we're diving into the world of stocks, what they are, how they function, and why they generate so much excitement. So what is a stock? Simply put, a stock represents a share of ownership in a company. When you purchase a stock, you literally own a tiny portion of that business. Think of your favorite company as a chocolate cake cut into millions of slices. Each slice is what we call a share. When you buy a share, you are claiming your specific slice of that company. If a company were divided into 10 shares and you owned 5, you would effectively own half of the business. While real-world companies usually have millions of shares, making your individual ownership a much smaller percentage, the concept remains the same. You might wonder why a company would sell pieces of itself to strangers. The answer is simple: to raise capital. Growing a business is expensive. Companies need cash to build factories, develop new products, expand internationally, or cover operational costs.
Instead of taking out bank loans that require repayment with interest, selling shares allows companies to raise money they never have to pay back. Let's look at Maya and her dream sneaker store, Fresh Kicks. Maya needs $100,000 to launch, but she only has $50,000 saved. Instead of borrowing, she divides her company into 10 equal shares. She keeps 5 shares for her $50,000 investment and sells the remaining 5 for $10,000 each. Jordan, a sneaker enthusiast, buys 1 share, giving him 10% ownership. With the $100,000 raised, Maya opens her shop. 5 years later, the business thrives and is valued at $300,000. Jordan's 10% stake is now worth $30,000, netting him a $20,000 profit if he sells. However, it isn't always a success story. If Fresh Kicks struggled and its value dropped to $80,000, Jordan's share would be worth only $8,000, resulting in a $2,000 loss. This is exactly how the stock market works on a global scale. Some companies also distribute a portion of their profits to shareholders through dividends, which is essentially a reward for your ownership. To trade these slices of companies, people use a stock exchange, a marketplace like the New York Stock Exchange or NASDAQ.
Today, you don't need to be there in person. You can buy and sell stocks instantly using apps on your phone. It is important to note that not all stocks are the same. They generally come in 2 types, common and preferred. Common stock is what most people mean when they talk about investing. It grants you voting rights in company decisions, such as electing the board of directors. While common stockholders may receive dividends, these are not guaranteed. The main advantage is the potential for significant growth, though they carry higher risk, as common stockholders are the last to be paid if a company goes bankrupt. Preferred stock is like the more conservative sibling. These stockholders usually do not have voting rights, but they receive priority when it comes to dividends. These payments are typically fixed and more reliable. In the event of a bankruptcy, preferred stockholders are higher in line than common stockholders, though still behind creditors. Think of preferred stock as a middle ground between stocks and bonds, offering more stability but often less growth potential. So, why invest in stocks instead of keeping your money in a bank? While savings accounts offer low interest, stocks have historically returned an average of 7 to 10% annually over the long term.
This potential growth comes with the trade-off of market volatility. Some investors hold stocks for years, hoping for long-term growth, while others trade frequently to capitalize on short-term price changes. In summary, when you buy a stock, you are not just trading a ticker symbol, you are buying actual ownership in a business. If you are considering investing, start with companies you understand and believe in. And remember, never put all your money into a single stock. Don't put all your eggs in one basket. Thank you for watching. If you found this helpful, please like and subscribe for more simple breakdowns of financial concepts, and leave a comment letting me know which topic you want me to explain next.